Mr. Derek, he suggested that he had only one exit, and so he probably is not the most qualified to come here. And I beg to differ with him completely, because it's not about the number of exits, but the process that he's gone through, and the narrative that he's able to bring to the podium is absolutely wonderful. Derek, as you know, he's the founder of redflagleads.com. It was Canada's largest, it is Canada's largest bargain shopping community. It was launched in 2000 to address the lack of online shopping information available to Canadians. It was acquired by Yellow Pages Group in February 2010. Post-acquisition, Derek launched Yellow Pages Group's foray into group buying with Deal of the Day. He left Yellow Pages in March 2012 and has since started working with one of his mentors at Kinetic Cafe, advising startups in Toronto, and he is involved with seed investments focused on internet-related startups. We had him for Angel Investors panel, and it was very impressive interaction. We know he'll outdo himself today because he's all by himself. Let's welcome Derek.
Thanks for having me. I want this to be as interactive a session as possible, so I have some slides, but you guys can feel free to basically jump in as I'm going through them if you have more questions about specific topics. There's basically two areas that I'm going to cover. One is just really about, this slide, my journey and my story with redflagdeals.com, the exit to Yellow Pages, what that process looked like, and the second is just a number of tips. But before I get to that, just a little bit of a disclaimer, like Lalit said, I've only had one exit, so that's good, but I would love to have more. There's many guys out there who would definitely have bigger exits than I have had, and like Sachin said, there's guys that are doing $100 million, billion-dollar deals that I'm certainly haven't been involved in. And at the same time, a lot of what I've learned has really come from advisors and mentors that I've worked with, so you can really thank them for the advice that they've been able to provide me, and hopefully that comes out. And so we'll just start with a little bit about me. Like Lalit mentioned, I'm both an entrepreneur now and angel investor. I think of myself first as an entrepreneur. I think that's actually much more interesting than being an angel investor. Angel investors are cool and everything, but at the end of the day, I want to work and build businesses. That's what really excites me, and I want to help other people, of course, that are going through that process as well. And that's where I'm involved with the Ryerson Digital Media Zone. I'm involved with Extreme Startups as a mentor as well, and then over at Kinetic Cafe, where Chris Carter, my mentor, is building his business. I'm the entrepreneur in residence. So as part of that, they invest in a number of different startups. We help mentor and screen them, and at the same time, I'm also working on my own project, and my project is Dossier, dossier.com. So you can check it out. It's in beta. It's very early, but it's really basically to help you prepare for meetings and make it really easy to know a lot more about the person you're going to meet, so that you can have interesting and common things to talk about, for instance, and try to grease the wheels a little bit. So enough about me. Let me tell you a bit about redflagdeals.com and our little story as it happened. So the reason we started redflagdeals.com, it was in 2000, and really I was a student. I didn't have a whole lot of money, but I am certainly interested in online shopping. I'm certainly interested in technology. I was interested in the internet and learning about how that works. So just taking a look at my own knowledge and my experience shopping online as a Canadian shopper, there actually wasn't a lot of resources out there. I looked at the US, the UK, and there was actually a lot more information. So it was a need that I had as a consumer, and I thought that I could take the information I've learned and basically share it with some people and see what happens. There was no business plan. I think all that planning is well and good, but it doesn't always happen that way. And so it was really something that happened in sort of happenstance, and the timing was right for us in the sense that I could cover a market that was fairly small. There wasn't a lot of startup costs if you're just running a publishing-based business. But I mean, even then, I didn't even think about it as a business. So it was really more about learning, and it just happened to, over time, probably took 4 or 5 years before it became an interesting enough business that I could pursue, say, full time. So it wasn't until after I graduated Queens, I took commerce and I completed the program in 2005 that I went and pursued it full time. So at that time, we probably had enough revenue that we could get by with 2 people full time. So it was myself and my first employee, who I've been friends with basically since grade school, that decided to pursue it full time. And I actually had an offer from Ernst & Young, for instance, because I went and worked there as an accountant intern for 1 summer. But I thought, this is a great time for me to sort of take the leap and give it a shot. And if it didn't work, I can always go back into the professional services world. Basically in 2005, took the leap. We continued to build the business. We were very fortunate in that this was a time when people were starting to talk about online shopping a bit more. There was a ramp up in terms of the people that are going to the web and willing and able to purchase online, so that helped us too. Retailers were obviously trying to attract those type of users, and we had them in droves on red flag deals. The business model then therefore became some sort of relationship with retailers. And there's really 2 primary drivers in our model. One was affiliate. So affiliate is basically where you generate a commission on a sale that you make or on a lead that you generate. So if somebody went over to Amazon and bought something as a result of a deal we posted on Red Flag Deals, we get a small commission for that particular transactions. And we can work with a number of different retailers with those type of affiliate deals. Our incentive was, of course, to find the best deals so that people would buy as much as possible, which would generate us more revenue. So we still had the incentive to find the best stuff. And the best deals ultimately became the ones that were the most shared. So a way that we grew very organically was just purely by the content, the quality of the content. We're in an industry where if you have a great deal, you probably want to share it with friends. You might want to brag that you got a fantastic deal on a TV or on an appliance or whatever it might be. So the nature of our content was just very shareable like that. The second piece was advertising. Advertising came on more strongly later. As we developed a brand, we can go direct and talk to advertisers and say you should advertise on redflagdeals.com specifically and pay for these placements and these sponsorship opportunities. Versus early on, when you don't have enough of a base to be able to go out there and command large enough revenues, and you're just in a channel buy, for instance, or you're in a blind buy through the agencies, through the ad networks, and so on and so forth. So our appeal was that we were Canadian focused because there aren't a ton of Canadian focused sites, and we're the largest of our clients. So if you were a Canadian online retailer looking to attract a Canadian focused audience, then this is the place for you. This is the place that hopefully comes top of mind, and that actually plays a very important role in how we looked at the acquisition further down the road and exiting our business. We wanted to be at the top in sort of their consideration set as a consumer. If whenever somebody thought about where do you go for the best information about deals or shopping on the web, they thought of redflagdeals.com. In Canada, that's value. That's value beyond P&L value. That's value beyond purely a multiple of cash that we can provide, and that helps you drive the acquisition value up. So in terms of traction, which is obviously a more popular word now than really fit in this lexicon before, we were generating about $3 million plus in annual revenue. We're growing really fast. We're highly profitable. It was a model that scaled really well. So we could write one piece of content, and whether we had 1 million or 2 million or 3 million people look at the site, it didn't really matter from the production side, but in terms of the revenue we could generate and the number of ads we could show and so on and so forth, it scaled. It scaled well. It was a business where if we could double our traffic, we certainly would not need to double our cost base. And so from that perspective, it was very attractive to any potential acquirers. They would look at the future and say, this is what it is today, but if we could do X in terms of traffic based on all the sources of traffic that they had, and in Yellow Pages' case, they had obviously yellowpages.ca, and they had Hack on the French side and a whole bunch of network sites. They could drive traffic to this property that would be in their network. They could basically drive future growth and future revenues and profitability and more cash flow. So from that perspective, very attractive as an acquisition target, and we're doing over 2.5 million monthly unique visitors per month. So room to grow still, but a significant number that you could go out and you could basically sell advertisers on specific site unique campaigns, and we definitely did that. So now it's well over 3.5 million, so they've continued to grow the site after it was acquired by Yellow Pages, which is certainly definitely part of the goal. So you guys can feel free to ask questions, of course. So in terms of the process, I sort of framed the slide as sort of the call. once we were sort of up and running and our core business mechanics were going, we started getting some inbound calls. We weren't at the stage where we were thinking, okay, the business has sort of peaked, or I want to stop running this business, or any of those reasons that Sachin mentioned before, and we want to sell. We weren't in that mindset. We actually came the other way, where people started approaching us and said, are you interested in investment? Are you interested in being acquired? And then some people just basically fishing for information for competitive reasons, or for comparables for US and Canada. And so I think we were very fortunate. It's always better from a value perspective for people to come and ask you whether you're available for sale than for you to go out there and say, I'm for sale. It's sort of just the dynamics of the deal and negotiation. If they want you, then in theory they're willing to pay more, versus if you really need them and you really need an exit. So whether it's true or not, to be able to create the perception that they're sort of chasing you versus you're trying to chase them, and that you have lots of options versus they might only have a few options in our vertical, the Canadian marketplace, looking at deals with a substantial audience, that will all increase the value of the deal. So the first time that we actually got a call that was down this road was actually a call that was in sort of the business development realm. So it was from a large Canadian media company, and they called us to see if there was a project we could work together on. And to be honest, we weren't really prepared for the call. We found out later as we went through the process more, they were basically trying to get a little bit more information, and then possibly look at acquisition and see how parties sort of felt about that and what that relationship might look like. But we just didn't know what was happening, and I had no experience in this, and I wouldn't even have known at that time to necessarily call advisors to ask them about that, because it just seemed like somebody's asking about business development. Okay, we can do that, right? We've done deals like that before. So we're just inexperienced, and so the first time around, in the end, that didn't really go anywhere. So we looked at different business development deals, but the economics basically just didn't make sense for either party to go ahead, and we never got to the point where we're talking seriously about acquisition. Do I think that was an opportunity if we were prepared? Certainly, but we just were not. So basically, first one in, first one out, probably blew that one. Next, and so we had gotten used to this process a little bit, and so we had decided then, when people ask about are you up for investment, are you up for acquisition, we at least had an answer, because at the beginning we didn't have an answer because we didn't think about it. So now we had an answer, and our answer was we were not looking for additional funding. We were highly profitable. We thought we could invest as much as we needed to in the business, continue to grow it, and so we didn't need an incremental $1 million. That wouldn't necessarily make a difference. And if we take on third-party investors, it sets expectations of what the returns have to be, and so on and so forth. So we thought we didn't need to raise. We're strong enough in terms of our capital position that we could sort of just continue and build our business, and we could build related businesses and invest in those. And we did a couple of those that ultimately for us weren't very successful. They probably didn't do any better than about break even. So most of the money and most of the value ultimately, when acquirers looked at us, came in the form of what we had developed as an asset at Red Flag Deals. And so that all led to basically in the fall, early winter of 2009, a call from Yellow Pages. So Yellow Pages called us, somebody from the corporate development office, and at that time we basically had a very honest discussion, very straightforward, probably lasted no more than 20 minutes. They asked if we were interested in investment. We basically said no, because we don't need it. And if you want to talk about acquisition, then we're happy to do that. We're always open to having that discussion, and we'll see where it goes. They took that back, and they said basically yes, they're interested in talking about that further. We set up a dinner with the CMO at the time, Stéphane Marceau, who was basically brought in to sort of revitalize the organization. And so I had a one-on-one dinner with him to really understand, mostly what their vision for the company would be, how they would transform their existing business, what the assets are, how he felt, we fit in. So that was the meeting that really, drove the acquisition forward. I think if that one didn't go well, then it wouldn't have happened. But we had both felt mutually comfortable enough that we wanted to take it to the next step. So. I think the tip really for that one, sort of lucked into it, was he was coming, because he's based in Montreal, and Yellow Pages is a Montreal-based company. he was coming to Toronto to meet us, which makes sense because in a sense they're pursuing us, quote unquote. And so for us, for me, I was like, okay, well, where do we go for dinner? So I got lucky in that I talked to his secretary, who was really nice and suggested that we go to a sushi place. So I took him to a sushi place, and everything worked out. So lean on the secretary if you can for any sort of hot tips and insider advice when you get to know that person. So Sasha talked about this as well. There's probably going to be an advocate on the other side for the deal. And maybe not everybody is going to see it the exact same way, because especially at these larger organizations, it's not that straightforward. There's lots of different considerations. There's lots of potential options. If they have the money, they can practically go out and acquire anything with the right amount of capital. So you need an advocate inside the company that you want to be acquired by, and you need them to feel good about the process. You need the trust levels to be right. You need to be able to pick up the phone and talk to them if something is going wrong, because sometimes maybe there's just too much due diligence in a certain area that's taking up too much time, or things are moving too slowly. You need to be able to accelerate the process. You need to be able to get somewhat of an honest answer from somebody to get a sense of how the deal's going, because you don't want to spend all this time basically dating, and then when you get to the altar, he leaves you, or the other way around, right? You're doing all this whole process and going through due diligence, providing all these documents. That takes time away from your core business. So what you want to be able to at least ensure is some degree of honesty and integrity between the parties, so that you can actually get a deal done. So that's basically call piece. I'll tell you a bit more about how we thought about the Yellow Pages group and why we thought it was a good fit. And one of the things that we had done based on some feedback we got from an advisor was to go and basically plan for a 3-5 year plan of where we wanted to be. And at this point, we were healthy, we were comfortable, we were growing. But the idea was to figure out what might a number look like, what might you want to be acquired for in X number of years, and then how do you sort of work that back and look at different acquirers, and how do you sort of attract these acquirers to come knocking on your door versus the other way around. So for us, when we looked at the landscape, we thought we're Canadian focused, so we're looking at maybe a handful of Canadian focused media companies, because we're a web-based media content property that would naturally be a good fit for somebody that is trying to build strength in that area. But the Canadian piece was actually part of the key, because for us that meant that it may make a lot less sense for a U.S. acquirer to look at us and pick us up, because it doesn't fit as naturally as into their portfolio. So that basically brought us to maybe 5 or max 10 acquirers that we thought would be worthwhile talking to, who could have the capital resources, the cash on hand, is interested enough in sort of the internet-related side of the business to have interesting discussions. So if any one of those 5 or 10 of them call you, then you absolutely take their call and do whatever you can to get back to them in a reasonable amount of time. You want to get really the deal momentum going, and that you're responsive without being sort of needy or desperate in any sort of way. So for Yellow Pages, the fit we thought was this Canadian focus, which was absolutely key to whatever deal we thought we would do. But also in terms of goals. So it might not appear that way at first, but the goal of Yellow Pages and Red Flag deals in many ways is similar. It's really to connect consumers with businesses with some sort of commerce-based transaction. They do a really good job, in like plumbing and roofing and those traditional offline industries, and we did a really good job in the online commerce industries, where they were very weak. So from a strategic perspective, our overlying goals were the same. They just did it in different channels. They were strong in offline. We're strong in online. They were strong in French, but much weaker in Canada and English Canada. So we had lots of great strategic value that we couldn't necessarily build, really, really quickly. And to think of it another way, if they saw this asset fall into another competitor's hands, like a Quebecor or a Transcontinental, one of those guys that are in Quebec in their backyard, then they might feel like they missed out on an opportunity. So that's good. That's creating some sense of competition, sort of real or perceived, which is always healthy. And if we looked at the future, where we were going to grow the business, at this time we're already 2.5 million. If you think about Canada, there's 30-some-odd million people, and not every one of them is online. Some of them are definitely under 18. So how big could we grow? We could probably do 2, maybe 3 times in terms of our overall traffic. But we were never going to reach 15 million monthly uniques or anything like that. It's just the nature of the the business in Canada. And where we needed to grow was actually in areas where we thought Yellow Pages had a lot of strength. So one is mobile and local. So we were doing a lot of online, a lot of national retailers, the guys who would ship anywhere across the country. But the reality is 95% of all transactions, even today, happen at the retail physical store level. And this was an area that obviously Yellow Pages was tapping into that Red Flag Deals wasn't nearly as much. And even if we were driving those retail sales, we could not track it. So we would drive millions of dollars to retail transactions at Canadian Tire, but we would never get credit from Canadian Tire for doing that because they can track it back. Whereas online, if we drove sales to Future Shop, they could track it. They could track it back to us as a source and get credit for it, and therefore get advertising dollars or some sort of compensation as a result. So we thought we could go more into mobile, more into local, which is more into traditional store retail transactions. The second piece is in the French market. As an independent without any sort of French traffic, and I don't speak basically a lick of French, it makes it very hard to enter the French market. And as a Canadian-focused site, you really do need to have some presence in French Canada. And for us, that meant probably a significant amount of expenditure to build staff and expertise, but the returns would not be as high as what we were experiencing in the English side. And if we had a partner like a Yellow Pages that had tons of French traffic, they could basically help us drive that traffic initially. And really the beginning is the hardest part. Once you get to the point where you have a community and people are interacting, then it's up to you to manage the community well and to provide what they want and make it easy for them to share content and so on and so forth. But to get to that sort of critical mass initially for a site like ours was really a difficult part, and could take years. So if we could accelerate that, especially in the French market, we definitely wanted to do it. So that's why we thought they were a good fit. When we looked at other potential acquirers, let's take a Torstar for example. When we looked at Torstar, we did the analysis, said probably not as good a fit because they had a lot of shopping properties. They had already invested in a Save.ca, for instance. They were doing flyer land, so we didn't provide as much of a strategic value to them. Like if they didn't have us, they would continue to invest in the properties that they did have. Whereas from a Yellow Pages perspective, they would almost have to start from scratch or acquire somebody else much smaller to be able to build expertise and audience in that particular segment. So we thought Yellow Pages was a good fit from that perspective. They had at that point in time a lot of cash in the bank. Now it's a different story, but that was also obviously attractive because they'd be able to spend money to pay for it. So I think it was a well-planned, well-thought-out decision in terms of looking at Yellow Pages as a strong acquirer, and we actually didn't shop around the deal very much. We did some sort of back channel checking to see if we were around the right area in terms of valuation, what's the level of interest, but for the most part, we didn't go out and broadly shop it or publicly shop it. It was really just pretty quiet and working with an acquirer that we thought was being fair, reasonable, and at the same time offering a good valuation. So this is a little bit of a deal process, and for us, I think it was pretty straightforward, and I'd be curious to hear what the general sort of time lengths are for it, but it was really about 4 months for us. From the time we got the call and had the dinner and basically showed real interest, we were able to sign paperwork, get the deal done in about 4 months. We were both quite committed to it. So initially what happens is, there's that interest. You probably will sign an NDA at that point, so a non-disclosure agreement, so that people don't sort of share information across the industry, willy-nilly, and sort of word gets out there that you're working on a deal and so on and so forth. So it's good for both parties certainly to do that. And then light due diligence happens in essence. So it's information sharing. They ask for a bunch of information from us. Definitely includes future planning, what do your financials look like, key employees, tell us about where your problems are, and so on and so forth. So at a pretty light level, because they can sort of only ask so much at that point. There's no commitment to complete a deal at that point in time, and there's no numbers, there's no offer on the table. So it's light due diligence that ultimately resulted for us in some sort of term sheet. So the term sheet will basically spell out high level, based on the information they have, this is how much they think they would be willing to pay for it. This is what the terms would be sort of afterwards in terms of earnouts and all that type of stuff. But it's high level, gives you a structure for the overall deal. And at that point, it's up to both parties to decide, are you guys close enough that you can work to get a final deal. Because whatever they offer is probably not the most that they're going to offer, and whatever they offer is likely not like the number that you're going to absolutely just jump for, right? Typically speaking, you end up somewhere in the middle of what one party's expectation is and the other party's expectation is, and basically you argue to figure out how far you get in between, on which side you're closer to, and how do you try to get more value out of it, and how do you justify getting more value out of it on the entrepreneurship side. And so we got to the point where we thought we were close enough. It wasn't what we wanted, but we wanted at least to explore further and figure out how can we demonstrate more value. And so I'll talk a bit about what we put out and how we put that forward. Basically, their first cut was looking at industry very commonly might look at the financial numbers. So your EBITDA, for instance, and do a multiple of EBITDA compared to, like Sachin said, what the industry and what the market in the public markets are basically showing. The funny thing, of course, about Canadian businesses is that there's not a whole lot of Canadian-focused internet companies on the market, right? So comparables are, it's pretty weak, I would say, right? It's very arguable, and it depends on how much they want to acquire you versus how much you want to sell. So it really becomes, the price is what they're willing to pay. And so, we ended up somewhere in between where we both thought the numbers were that we were both, happy with and we could justify. But the process of getting there, I'll get back into a little bit more and talk about some of the value drivers that we tried to put forward, so that we moved away from a pure financial buyer, because we had financial buyers who would look at our P&L, including guys in the US, and say, okay, based on your, they didn't really care about the business or the people or anything like that. They would basically just, replace them with their own teams because they felt they had the expertise to run this type of business. They just looked at the P&L and said, okay, we're going to be able to basically give you X times your EBITDA, and you can actually go away. We don't even need you to be there after the transition period. So maybe that's attractive for some people. In our case, wasn't as much, and because you're not providing that sort of human capital value, therefore the valuation is going to be lower. So we want to, as much as possible, move away from the pure P&L based valuation. That to us was a starting point, and then we built on top of that. These are all the things that we add above and beyond pure P&L that we want somebody to pay for it, and if it's not you, then we'll just continue on our merry way. We have options. We don't need to sell, and you can come back to us later, or we'll go and do a deal with your competitors. So putting some sort of deal pressure on them. So for us, like I said, I think overall they were very responsive. They were very fair. They were very reasonable. They didn't burden us too much in terms of the due diligence.
So who should you have, like a lawyer and accountant, to negotiate all this?
So we have a lawyer and accountant, but they weren't necessarily in the front lines negotiating, so I was trying to negotiate a lot of that. And you can play it a couple different ways. You can use the lawyer. The lawyer would be more involved. I think the accountant less so, because the lawyer is looking at the terms they provided, right? And they can push back from a legal perspective and say, for the industry standard is, for instance, a retention of 2 years versus 3 years, and then you can argue about that and what does that really mean in terms of the value of the deal. And so you can have your accountant or your lawyer actually sort of play, bad cop, arguably. Like you could be, really nice about it, and, but you can say, oh, but my accountant or my lawyer says this is an industry standard, right? So I don't have expertise in that. I have to rely on the lawyer and take their word for it and use them as a point of leverage. I mean, you have to be careful, of course. You can't do it too often, and you have to balance it. But I would recommend working with the lawyer and then yourself as the lead from the business side. And you can also leverage your other shareholders. So for me, I was the majority shareholder, but I had employees that were shareholders. And so you could use them, and they could have a different opinion than you, right? They don't necessarily all want the same thing. So you could express that and say, my other shareholders wouldn't be willing to sell unless this clause was changed or the value was Y, and use that as a point of negotiation versus just saying I don't like this, that.
What about having? So sorry, go on. At what point do you show the financial statement?
We showed it pretty early. Like after the NDA was signed, we showed the financial statements.
This is all audited?
We were unaudited. So I think as a small company, you're unlikely to be audited. And so what they would do at the next step in terms of deeper due diligence, when you've sort of agreed to an overall term, at least in our case, was they could call your clients and say, okay, I see that you guys have done this much business, I'm doing due diligence, so is that accurate? Are you going to continue to do business with them in the future? How do you feel about that relationship and so forth? So your clients become particularly important at that point, especially when they look at your top clients. So I'm sure they will say, okay, they'll look at your top 10 clients and say, what proportion of revenue do your top 10 clients drive? Because that's risk, right? So when they're doing due diligence, they're trying to pull out as much risk out of the deal as possible. So if they can see that your top 10 clients are driving 80%, that's not good. If they see top 10 clients are driving like 20 or 40%, that's much better, right? Because that gives them more comfort that even if a top client leaves, then you'll still have money coming in.
You have a question?
Yeah, would it be unusual to have an investment banker by your side for this sort of deal? It sounds like you didn't, but with
I don't think it'd be unusual. I think a lot of it would depend on like deal size, and so at what size of a deal would investment bankers be interested in being involved? Or there's guys that are brokers in essence that could help with this. So I think it depends on the deal. It depends on their expertise in the industry. They can certainly be helpful. They obviously have a cost to them. You want to do your own research as to the value they've provided in the past, but they can negotiate with you or negotiate on your behalf as well. It just depends on sort of how you feel about the various parties, because they could actually do the same on the other side, right? Like they could and sometimes they'll bring in a third-party advisor on their end to talk to you about valuation and so on and so forth. And so they did it in that case, and we didn't, and we just sort of negotiated it sort of amongst ourselves and with the lawyer. So the lawyer, I think, is actually part of this group and has presented here before. Arshid Tabrizi was the guy we used. So he actually has background. He worked in the U.S. and he has a past bar in the U.S. and was practicing Wilson Sinstone or something like that. And so he had a very strong technical background, and he had a good bunch of relationships where you could go and ask other advisors, how does this deal sound compared to what else you've seen in the industry recently, and use them as a sounding board without bringing them on as a formal advisor.
Can I ask you one more question?
Yeah. More questions, go for it.
Does the lawyers work as a percentage, or normally it's work as a fixed price?
Fixed price. I mean, they could work for a percent. I think this is, again, up to you how you negotiate the deal. And I'd be curious as to what your feedback is, but it was a fixed hourly rate for us.
It's typically hourly rates, but there are alternative fee arrangements that have been done.
Okay. Any more questions so far? Okay. So now really moving on to the tips and what we found as, for instance, value drivers. So I've talked about some of these, and we can go into them in more detail. You let me know what you want to learn. And one is really the strategic value. So you got to move away from this pure P&L value. If you just sell your business for P&L value, arguably you could sell your business for P&L value any day of the week. It doesn't really matter. If you're bringing in X number of dollars on the top line, X, Y number of dollars on EBITDA, there's going to be somebody from a P&L perspective who will pay for that. So that's, in my mind, baseline, right? You want to get more money out of it than that. So the second one is synergy. People buy your business because they think they can generate more revenue, more money. There has to be an upside to it, right? They don't want to buy a business that's flatline. And so, you want to basically build a scenario for them, help them understand how, you becoming part of their company will leverage their assets to grow your portion of the business faster, bigger, generate more revenue, bring in more money. So it's worthwhile for them, right? When they go back and they do their analysis, they have to say, if I pay X today, it's going to be, pay off in 5 years, 2X if they can, build this scenario where they get double the traffic or 1 million more unique visitors or whatever that might be. They have to have a credible case that they sell, to their executives to say that investing X today is going to be worth Y tomorrow, and therefore they need to see some sort of synergy that's going to accelerate the expansion. Otherwise, they could just invest and you continue to grow sort of organically. It doesn't create that much incremental value. And you want to create a scenario where if you create incremental value, because then they're, in theory, going to be willing to pay a portion of that incremental value in the acquisition price. Market leadership is the other thing that we push very hard. So if you're number one in your category, there should be a premium for that. And we were by far the largest site of our kind in Canada. And this is something that, if you have it, then you can sort of play this card, and there can be a lot of value if it's defensible, and there can be less value if you're number one, but really it's in a market that's not as defensible. So what made us arguably more defensible and why we're still the largest site today is the community. So building community is very hard, and once you build a community and they're comfortable, sharing information in that community, it makes it a lot harder for competitors to sort of break in to that space. It's something that has a little bit of a network effect. So if you think eBay, for instance, it's very hard to create a second eBay because there's liquidity in that marketplace. In a community like ours, there's liquidity in the information. The other thing that we had is when people share and post information in our community forums, for instance, that ranked very well for SEO reasons. We're driving a lot of organic, or basically free traffic, and this is something that's very difficult to replicate, and therefore, they should pay for that. Defensibility, I talked about time. So if they're in a rush to get into that particular market, then this is something they'll basically pay to get in now. And if they're competing with other guys in for Yellow Pages, it's really in the shopping space. So if Tourstar is investing aggressively and Yellow Pages doesn't have a horse in the race, this is a way they can sort of leapfrog the competition and cut out that time aspect. Could they build a site like what we built over a period of Y years? Maybe, maybe not. So there's risk. And then there's, even if they could, it would take them a lot of time to do it. So this is a shortcut for them to be able to get there. So it's, again, the build versus buy decision in terms of time. Competition talked about, obviously, if there's competition in the deal, or if they believe there's competition or the potential for competition, all the better, because that means, you could basically, you need the ability to go and say no in essence, right? If you can't go and say no, then they're just going to negotiate all the terms in their favor, and there's not much you can do about it. If this is your only way out, and it appears like it's your only way out, then they're not going to give you the best price. They're not going to give you the most value. People, obviously, they want to retain key personnel, so you have to work that out with your staff as well in terms of retention agreements, for instance. You have to hopefully make sure that they're on board, and that's one of the other keys that I'll talk about a little bit later. But the people, in many cases, are what they're also interested in, because they think people could potentially help their organization. If you're a huge organization and you need, typically people think they might need some more innovation, they go out there and sort of buy innovation and try to bring that in. And hopefully you'll help them as an overall company be better from a person perspective, and then there's value for that. Next one, we talked about at length, so I won't go over that. That's the multiple of P&L. I mean, you can look at EBITDA, which is probably the most common, but you would rather look at multiple of revenue or other items that potentially give you more value. Technologies related to patents, if you have any, or other unique technology that you've sort of built. And then option value, which I've touched on as well, is the ability to really say no, to be able to say, okay, I don't want to do this deal, I don't need to do this deal right now. Why don't we see where we are in 6 months and we can sort of revisit it, or I can go talk to other people at the same time. So the ability to be able not to do the deal actually gives you more momentum to actually get the deal done in a sort of counter cyclical way. Tips, so this is the one that I got from my mentor, is Chris Carter on my advisory board. So it's really thinking about where you want to be. So what's your end goal? Is your end goal to sell the business in X number of years? Is the end goal a particular number that you have in mind? And after the acquisition, what do you want to do? Do you want to be in that business for 2 years? Do you want to exit the business immediately? You have to keep that in mind so that you can build towards it. So this goes back to the planning. If you know you need to drive, and you can look at the industry numbers, right? So if you want to build a business that exits at 100 million in your industry, what type of bottom line do you need to have? How much EBITDA do you need to have to get to the multiple in your industry to get to a $100 million exit? And then you can back that out over a reasonable number of years and say, okay, I got to grow by this much every single year to be able to get to the point where somebody, in theory, if market conditions were the same, which of course they change over time, they'd be interested in acquiring my company potentially for X. So you need to be able to plan and basically back it out and then measure. So we did it on an annual basis. And we looked at it all the time, but we seriously planned on an annual basis, and we looked 3 and 5 years down the road and figured out, okay, who are potential acquirers at that point in time? How much revenue will we need? What are the multiples in the industry? Mentorship, Sachin also touched on this as well. I think this is really important, so going and finding somebody who has done it before getting their input and advice. So my lead advisor was Chris Carter. He founded Thin Data, which was an email marketing company. He sold to Transcontinental. He was also focused mostly on Canadian clients, so your TD Banks, your Blockbuster Canada, your large enterprise guys in the Canadian space. And so when he was looking for people to acquire his company, it was naturally Canadian media companies as well. And so he did a couple years ahead of me and was able to provide me some fantastic advice in terms of planning and how to work with the deal structure. What can you or can you not ask for, or what might be items that are sort of going to raise red flags. How do you keep the deal momentum going as you're negotiating, because you want to get them more and more excited about the deal and close faster and faster, and not the other way around. You don't want to have your core business deteriorate over the course of the negotiation. And somebody who's industry relevant, somebody who's talking to the same guys that might acquire you certainly helps. And most entrepreneurs, for the most part, are happy to help. If you reach out, and they'll be happy to spend some time with you. I think people are pretty open to that. These days, it's really easy now with LinkedIn and social media and all of that, just to stalk potential advisors, and you can have different relationships with them. Some of them are paid or in cash or equity, and some of them are free. It depends on how you want to work it, and then for what the commitment level you're looking for them to provide is. But I worked with Chris throughout this process. He was on my advisory board, which had about 5 people, and he was the most helpful one. He was the lead advisor, and I'm still working with him today now at Kinetic Cafe, which is his new business. Next up is around stakeholders. So this is where I think the first thing is, who are the stakeholders, and if you take on third-party investment versus if you bootstrap and don't take on incremental investment. So for us, we were fortunate enough to have bootstrapped the whole thing, so we didn't need to go and talk to investors, say, okay, should we go and sell the company or should we not? I could basically make that call, and so I had the flexibility and the option to do it today or just continue to run it as a lifestyle business, right? So it doesn't, you don't have to exit. These are exit strategies, but your exit could purely be generating dividends that you take in every year and you find somebody else to run the business. That's totally fine. But if you have investors involved, then the expectations are different. People typically are investing money because they predict that you'll have an exit. And so if they invest money at a certain valuation, their expectations for investing $1 million might be that in 5 years they're going to triple, quadruple, 5 times their money. So you have to think about how you're going to be able to get to an exit of that magnitude, or you shouldn't take their money, because if you have, if you do not have alignment in those investor expectations, then you're sort of setting yourself up for a scenario where down the road there might be a deal that you want to do from an exit perspective that doesn't make sense for the advisor or the investors, and therefore you become a little bit in conflict, and it's never good to be in conflict with your investors. So keep that in mind as you think about how you deal with valuation and as you deal with your investors and their expectations as well. For employees, this is something that we were quite sensitive to because I worked with these guys since we were a very small company. I was very close to them. We're friends as well, outside of work. So there will be change. Some employees will react better to it than others. So basically, keeping them prepared, keeping them up to date. Like, you can tell them, we did explicitly that our goal was to get to this much revenue for the business, and we think at that point in time that somebody may acquire us, at these type of multiples and so on and so forth. There's no certainty around that, but just to put it out there and set the expectations so that they're not totally blindsided and surprised that something like that is happening, because you do also want them to carry over, and you want them to continue to work with you post-acquisition. For your customers, we talked about they might get called, but your customers hopefully feel this will be incremental opportunity. Maybe they'll be able to potentially reach people in French Canada that were able never to reach before in English, because now you have a larger audience. So you want them to feel good about it versus, oh, you're going to go into some big company and you're not going to be as nimble or as interesting a platform for us to advertise in.
Can you speak just very briefly to the average percentage that some of your employees, like non-founders, just random employees, early ones, late ones, might have got? Like
sure.
0.5%, 2%, whatever the case may be.
So we had 4 employee shareholders.
Yeah.
So maybe we were a little bit unique. So the guys that got the biggest from the employee perspective were obviously earlier and had a certain skill set. So what I don't have is technical skill set. So our CTO had sort of the biggest share, and then our outside of me, and then the next one would be the person that was second hired. so are basically a chief operating officer, if you want to put it that way. So percentages, I think, vary widely. So in my particular case, I would say like over 20% of the business was, from the employee base, and it really depends like how much you give each individual person, because it's not just about they came in first, they should get more. It's also what skills and what assets they have to sort of bring to the business. So even though our CTO was not the person that we've hired first and was the earliest in the business, he had more equity because of the value that he provided. He was providing expertise and again, many years of experience working at like Quebecor and large companies. He had other companies that were acquired in the past, and so he was bringing expertise above and beyond, purely being an employee and an early employee. And those guys do deserve more equity, and if you can't give it to them, they're not necessarily going to come on board anyways.
Would you have got them instead if you had, say, investor money that you could have used it instead of giving stock?
Yeah, so you can definitely, you might attract different types of people, but that's not to say they could both get the job done. So there's always a trade-off between how much salary they're getting versus how much equity they're getting. And so most of the guys that I hired early on, and guys like our CTO, Mike, he was more interested in the equity side. He had made some money in the past already, so he was interested in upside and the salary. There had to be some salary and meaningful salary, but if we tried to go hire him in the open market, his salary would have been much higher, but he wouldn't have had very much equity at all.
Cool. Thanks.
Any more questions? Okay, I think I basically only have one more slide. So the last, there's two, but the last one on the tips really is about earnout. So, the advice that I was given and that I live by is basically you can forget about the earnout. Earnout should be sort of icing on the cake, should be gravy, because you will never know what will happen after the company's been acquired. And a perfect example was actually the scenario I went through. So Yellow Pages, and we did do some of our deal in stock. The stock basically tanked, like over 95%. Lower than what it was when we were acquired, and they did a whole reorganization as well. So, it didn't work out exactly as we would have pictured. They weren't able to invest in the businesses the way that we wanted them to, and this is something that you just can't predict, right? Once you sell your company, it's not yours, so you don't set the priorities, and if you set earnout targets that are based on a certain set of assumptions, and then the assumptions change, you basically have no leverage to go back and change that. So if you're not happy with the deal as it stands from the time you close, and then you probably don't want to do the deal, or you might want to reconsider how you structure the deal, because then you're taking more risk. And the idea of an exit in many cases is to really try to take risk off the table and try to monetize the value that you've brought. So if you're just leaving more risk on the table over a period of time, then it's not necessarily the same thing. So just go in with open eyes in that sense. And other tips, products are easier to sell and be acquired than services. If you have scalable processes, that's great. Momentum, I've talked about. If you focus and you're the best at something and you're the top of your sort of consideration set for something, then you're more likely to find a buyer. And then how do you want to plan sort of your exit from your exit? How do you want to leave the company, and what type of shape, or what do you want to accomplish while you were at the company that acquired you? And then for further reading, I would totally recommend Built to Sell. I didn't read these books before I did the process, so maybe I would have got more money if I did. But Built to Sell is really thinking about traditional service-based businesses and how to make them more product-based. What are the drivers of acquisition value? So there's definitely lots of stuff from this slide deck that is pulled from there. And the second one is venture deals, which if you're taking on third-party investment, even if you're not, there's a lot of really interesting insight as to how the venture industry works, what terms and what language you should look for in the legal documents that you're signing from investors, but even for employees, like what's important, what like you mentioned, like what are they looking for from the employment agreements and so forth that need to be covered as a part of the overall acquisition. And that's basically it. So if you want to reach out to me, my email address is dzito@kineticafe.com. You can also find me on Twitter. You can check out the Kinetic Cafe website, and you can also check out the site that I'm working on now, Dossier, which is public beta, so feel free to give me feedback. Thanks for having me.
Yeah.
Quick question. When was the point when you decided to work with professional accountants and lawyers? Because we know like investors going to look at your financials and agreements and legal stuff, right?
So we worked with a professional lawyer earlier than we did with a professional accountant. So we worked with like a bookkeeper early on, right? So you can bring in a bookkeeper to basically keep your books in a very straightforward, we use QuickBooks fashion for $15, $20, $25 an hour, depending on what type of work you're looking for them to do. And you might need them once every other week, for instance, which we did for a long time. So I would recommend you do that earlier because you probably don't want to, and I did this for a while because I guess I had some accounting knowledge. Your effort is probably not best spent based on bookkeeping. So you want to bring in somebody to help you to do that if you have the capital. And then we hired a lawyer early on because, again, you want to mitigate risk. So maybe because we didn't know anything, we didn't think about it as a business, we didn't hire a lawyer at the beginning. But if I start again, and I did start again, I would definitely from out of the gate, if you have enough capital, to go hire a lawyer to do like incorporation and some of the things that you just need to set right at the beginning because you need to protect what you have today, and you need to be able to manage that risk. So lawyer earlier, and accountant you can wait until later, and then your lawyer will pick up more business as your business grows, and you'll basically engage them further. So ideally, you want to work with a lawyer who can sort of grow with you, and hopefully somebody who is interested in what you're doing enough that they might be able to even send you leads, or that they can at least see that you have potential, right? So there's lots of firms out there actually that have programs, and I think you guys do for startups, because startups can't afford these big legal fees from the traditional firms, but the traditional firms are interested in getting you in early with the hope that your account will grow and you can be sort of the next Twitter or Hootsuite or whoever it might be. So you can probably talk to some of these guys that you think might be out of reach, and they might have programs for you.
Excellent.
When do you actually start thinking about your exit strategy? Was it earlier on? Because especially in the tech startup these days, with the lean development and the fast, just put it out there kind of style of thinking, you don't even have time to come up with a complete business plan. You just go with a business canvas and you just get it out there, and you don't have time to think, okay, how am I going to exit this? You're thinking about, let's put it out there, let's put it out there, let's put it out there.
Yeah, so when we started Red Flag Deals, I didn't think about it at all. I had no idea that it would be a business. We started thinking about it when people called us and sort of, in a sense, asked us about it. So we are naive, and I would recommend you think about it before you get those calls, because those could be opportunities that could actually turn into a sale right then and there. That being said, the second time around, and I'm working on this dossier business, for instance, I try not to think about the exit per se. I think the exit is important in terms of potential paths, but that's really all they are. They're potential paths, and frankly, they don't really matter that much if you don't have a business, right? So first and foremost, I think build the business, and then you'll have opportunities to exit. The things I want to think about are, what's the market potential? So this is where it goes back to what's your fit with investment. So actually, when you look at Red Flag Deals, it's not a great fit for venture capital because we're focused purely on the Canadian market. So we're not going to be a billion-dollar company, and they're not going to get their 100x out of us that they really want, and they want home runs, right? So for us, it didn't make sense to take on venture. So if I want to enter a market, now, hopefully I enter a market that's international, and that would make more sense to take on money. And if you're taking on money, they will obviously think about what that exit looks like, and you want alignment on the exit. So you want to make sure that if you're taking money at a $2 or $5 or $10 million valuation from them, that an exit of what would it take to make them happy? Would they be happy with a 5, with a 20, with a 40? If you have to take on money and get a $100 million exit, the number of $100 million exits are small. If you get it, obviously great, but the chance that you're going to get it is obviously lower from a pure statistical perspective.
Thank you so much.